Okay, good afternoon, everyone, and welcome to our panel discussion on managing risk on mining projects. Mining by its very nature involves a lot of significant risks, everything from environmental, social license and safety concerns through to financial and operational challenges. So today our distinguished panel, we're going to brings a wealth of experience and insights from various facets of the industry. So we'll share some first-hand experiences, lessons learned and best practices. So allow me to introduce our panel. Um, so we've got Kate next to me. Kate's from Clifford Chance. Next is Neil Foster, Chief Sustainability and Risk Officer at De Grey Mining. Steve Wateram, Chief Financial Officer from ASM. And Aaron Borg, Regional Co-Head, Metals, Mining Industries, APAC Societe Generale. So obviously managing risk in mining projects is high stakes game. The line between successes and failures is razor thin. The inherent unpredictability of mining operations from geological surprises to fluctuating commodity prices demands a robust risk management strategy. So, when we look at a mining project, they're very inherently complex and they're getting more complex as time progresses. Just the traditional complexity of the iron ore bodies, or the ore bodies and the geotechnical challenges, how we secure funding, all the test work that you need to do through the various phases of a project, all have their unique hurdles, let alone all the additional logistics of bulk services, critical process of obtaining permits, and social licenses and further layers of complexity. So on that note, we'll start some questioning, and I'd like to start with you, Neil. To explore the process of obtaining the right approvals for new mining projects and the subsequent funding, what are some of the key regulatory approvals required for new mining projects, and how is this different in Australia?
Small question to start with.
Okay, nice and easy.
Afternoon, everybody. I think mining projects, depending on the nature of the project, the nature of the complexity, but there's a few key approvals that are going to be required. Access and tenures, off the bat straight away. You may have found your resource, you've had your exploration program, you've got yourself an element of funding to start looking at development, doing your feasibility studies and the like. If you haven't got tenure, if you haven't got access agreements locked in, you're in trouble already. Primary and secondary environmental approvals, depending on where you are, which country you are they with the national government? Have you got state level approvals to get in place? You don't necessarily need to have all of those up front. Some of those will be more into the detail as you go through your project development. But unless you've got your primary approvals, you haven't got a project. So you've got to be a long way down the road to support those in terms of the data you've got to support the impact assessments that's going to get you those approvals. Have you done your consultation in relation to all the stakeholders associated with it? And it doesn't matter which country you're in. If you haven't got a primary approval in place, you're going to struggle, and you're going to struggle because that approval is going to put some limitations on your project design, your layouts, your access. Do you need to look at transport, infrastructure? Have you got port access? Have you got access to water? Have you got access to power? Have you got access to people? So as a whole myriad of approvals required, different projects require different approvals for it. But the big ones, primary environmental approvals and a government tick to say you can go to the next step and get into further development gets you a long way along, but not all the way. But it's multi-years, and most people in the room will understand that process. But I think from a funding perspective, and I'll defer to others, having those primary approvals really enables them to get involved and have a look at the project in earnest.
And are there any sort of common challenges that you're seeing that we're facing in the industry at the moment?
Timelines. Particularly, so for any company that's a sole project developer, timelines will be vital. The longer permitting spins out, the more likelihood you are looking at a dilution of share price. You're burning investors' money. You're putting yourself at risk of things like aggressive takeover. So you don't want to be in that cycle where effectively you're trying to put in or having to put in further cap raises. So timelines for approvals is a very open and understood issue across the industry in Australia, different for other jurisdictions. But I do know, governments are looking at how they can increase their efficiencies, particularly supporting green energy and critical minerals projects because of the imperative, but also supporting broader commodities and economic development. So I think collaboration between industry and government is getting there to make sure we can achieve timely and sustainable economic development within the country through mining.
Okay, thanks, Stephen. Some of the key approvals and milestones required before securing funding for a mining project. What are some of those?
Yeah, so I think in terms of ASM and our location in Dubbo, we're fully permitted there already. So perhaps to talk specifically to some of the points that Neil raised, so we've got our development consent from the New South Wales government in place. That happened in 2015. And from the federal government, we've got our approval under the EPBC Act. That also happened in 2015. And then our mining lease was also granted in 2015. Perhaps we're a bit different to some projects because we own about just over 2,000 hectares of pastoral land around Dubbo, in addition to having water rights there. So that land access and perhaps negotiation issue that some projects have in other parts of Australia, we have less of that. So that's I guess a positive for us. We're also regional rather than remote. So from an infrastructure perspective, it means that whether it's road, rail, grid connections, they're all close at hand for the project. Yeah.
Okay. And then Kate, I might ask you, like when you're structuring the project to obtain investment treaty protection, how do you facilitate this process?
Thank you, Michael. So investment treaty protection does facilitate and help mining companies obtain financing, so secure financing and to begin with, and also negotiate better terms for any loans that it is looking to get from banks and during its debt fundraising. So let me just explain how that works. Someone in an earlier panel said money flows where there is certainty, right? So for a mining company which has a project abroad, so which has a mine outside of its home jurisdiction, what provides more certainty is if there is a investment treaty between its home country and the host country where the mine is located. So for an Australian company, for example, with a mine in Argentina, there is already a treaty, an investment treaty between Australia and Argentina. So there's more certainty for that Australian mining company and for its mine. What that means is, under that investment treaty, Argentina has agreed to provide certain protections to the mining company. So Argentina has guaranteed to treat the company fairly and equitably, which is a pretty broad protection, right? What's fair and what's equitable. A lot of things fit into that category. It has agreed not to discriminate against the Australian company in favor of another company from another foreign country. It has agreed not to nationalize the mine. It has agreed not to expropriate the mining permit. And so what that means is the Australian company has that protection already. What's unique about investment treaties is they're not negotiated between the mining company and the country, right? They're negotiated at the country level between Australia and Argentina. So the Australian mining company doesn't have to do anything. It doesn't have to negotiate an agreement. It doesn't have to sign an agreement, but it still benefits from those rights and those protections. And there are more than 2,000 investment treaties in the world. A lot of countries have investment treaties between themselves, but some countries don't. So Australia, Argentina has a treaty, but if an Australian mining company is looking to invest in Africa, there are not a lot of investment treaties between Australia and Africa. So if a mining company is looking to explore or exploit a mine in Congo, then it has to restructure its investment in a way to get this kind of protection. And the way an Australian mining company can do that is by setting up a shell company in Mauritius, for example, because Mauritius and Congo have an investment treaty. And going through Mauritius will help the Australian company get that protection. And once you have that protection, it can be used to reduce sovereign risk. And that matters for financiers, right? That matters for private equity firms, and that matters for banks. So you might have already been asked in this conference by private investors, well, what are you doing about sovereign risk? And that's your answer. You don't have to do anything, but you have to know and tell that investor, we are protected. We are a protected company, and we have those guarantees from Argentina to treat us fairly and to treat us equitably. So when with banks, for example, there are concrete financial benefits you can get by not doing a lot, just mentioning that you're a protected investor when you negotiate the terms with banks. You can get lower interest rates because banks care about sovereign risk, and the higher the risk is for the loan, the higher their interest rates. You can get larger loans, negotiate larger loans as well, because banks respond to risk by lowering the size of the loan. You can get no collateral. The more protected investment, the less risk, the less use of collateral. You can get longer maturity dates or no covenants as well, because banks, again, respond to risk by restricting what a company can do with the money that they're loaning. So those are real concrete benefits that a mining company can get when looking to secure investment by not doing a lot. In practical terms, what my clients ask me to do is write them a memorandum to the bank that they provide to the bank during the due diligence process that banks undertake that says this company is protected under an investment treaty. And with that memo in hand, mining companies can negotiate better terms. So that's a really powerful way to, one, secure financing, and two, negotiate better terms for your financing.
That's good, Kate. In the mining sector, a significant disconnect often exists between what the mining project company deems sufficient in feasibility studies and the stringent requirement of financiers. So Aaron, from your perspective, what are the areas of focus for financiers, and how critical are comprehensive feasibility studies in attracting potential investors?
So when financiers look at backing a project, they are looking at things very comprehensively. So a proper technical analysis and a proper comprehensive due diligence process is essential. In terms of what areas they tend to focus on, it really does depend upon the project itself. Every project has unique areas of focuses. I suppose one of the key areas is people are very focused on technical feasibility. And this is really, in many respects, determining that the technology being proposed is effectively going to work. The gold standard here is really having technology that's being commercially proven, that is not just in a laboratory, but actually has a real track record of commercial production. Now, of course, that's not always possible. And, supply chains are changing, especially with the EV supply chain. And customer requirements are different to what they've been before. So we do know that a number of different processes are required to meet that demand. So what we are seeing in the market is we are seeing a number of different projects being proposed, which will use either new technologies or variations of existing technologies in a new way. So that puts obviously a lot of pressure then on the test work, and then the focus becomes, is that test work really adequate for what is being proposed? Often what we have found is that, especially for some junior companies with smaller balance sheets, they don't necessarily have all the capital that's required to do a fully comprehensive test regime. And there's a bit of back and forth just to make sure that the test work has been duly performed. That's one of the recurring things we've found. I suppose another area of focus is just on the financial robustness. Obviously, as investors and financiers will look at projects, they will look at the model, but they'll make changes to it because they do want to really understand what the underpinning assumptions are behind the figures. What what people are fundamentally after from a financier perspective is are assets that can survive a commodity cycle. So real corrections to prices, because prices do ebb and flow. That's the reality. And so we would like to see projects that can withstand the commodity cycle, so therefore are cost competitive. And probably just the last area of heightened tension would be around ESG. When a financier is involved in a project, when it comes to ESG matters, it's just not about that project itself. It's really about the reputation of the institution as a whole. Gone are the days when institutions that are large and global can really just segment issues in one region or one particular state or whatever it happens to be. For global corporations and global investors, what goes on in one area of the globe does have repercussions throughout the entire franchise. So ESG is an area of heightened concern.
Okay.
And on that point, I think I've seen previously there have been failings whereby companies have not recognized there is a disparity between the environmental permitting process and what financiers are looking for. So a proponent may well get their permits in place, do the work necessary to get themselves across the line there, and then go down the financing route and realize, hold on, there's a standard that goes over and above what I needed to do to get my project done. And even in Australia, the regulatory regime does not get to the standard that banks and financial institutions are now seeking. So it's understanding where you're going to go with your financing and getting the data and work done early enough that's going to cover not just your approvals, but also your investor requirements.
And Steve, just around that financial models and projections, what have you found most persuasive to investors in the mining sector?
Yeah, so I think the point I'd highlight, perhaps slightly differently from someone sitting inside a bank, is as a CFO trying to raise a full financing package for a project, debt, equity, mezzanine and whatnot, you have to understand the different risk appetites of the different participants in that debt stack. And obviously, if you start with equity, they've got a higher risk profile, but they expect a higher return. The banks will want to lock down every single risk, quite rightly, because they get a fixed coupon. They look to fully amortise within a certain period and get to be repaid. They don't get the upside, if you like, that equity gets from the project should it go extremely well. They just want to get repaid. So in terms of what we do with equity investors and the sort of feasibility study results that we would provide to them in a capital raising, that's a much lighter level of detail than what you would need to go through a full bank project financing process, which is going to include market due diligence, technical due diligence, legal due diligence. The list goes on. It's an expensive process for junior companies to go through. So you have to make sure that you're ready and able to pursue that in terms of having your data room information ready, having an idea about which independent advisors that the banks may wish to appoint. If you've got a syndicate of banks, you want to try and corral them into using similar legal firms, similar technical advisors, so you don't get your cost blowing out of control. So yeah, for me, it really comes down to understanding the different needs of the different investors within the stack, when they can fund, and at what point in your journey.
All right, thanks, Steve. And Aaron, how can market risk be managed to meet the needs of the investors in new mining projects? And how does this differ in critical minerals versus the other commodities?
Yeah, so I think there's two main areas of market risk. The first one is really about making sure that there's an end customer. And so what that really means is that investors and financiers, especially at that initial project stage, would like to see an offtake contract put in place. This is not always required. It depends very much on the commodity. If you're in the gold space and it's a product that can be easily sold to a refinery, that's not really required. But if you're, in most other instances, financiers will want to see some sort of offtake contract. In that case, counterparty selection is quite important. They want to see people who are creditworthy. We have seen instances in certain commodities where there's been excess supply, and off-takers have really just renegotiated or reneged on their obligations. That's a reality. And when that happens, you of course, you have legal recourse, but the reality is it's sort of hard to exercise it against your main customer anyway. So what we like to see is strong embedment into the supply chain so that those kinds of counterparties can manage risks themselves through the supply chain rather than having to renegotiate. For highly specialized commodities, what we've been seeing is a strong strategic alignment. This is really one of the key success factors, is ensuring counterparties with strong strategic alignment with the actual product being produced. So in other words, that the production is some way relevant for them to achieve their own success factors rather than just merely trading around it. So that's one of the key aspects we see. The other one obviously is around price volatility. Naturally the best way to manage price volatility is to have a really low cost operation. And, this is sometimes possible, but as we're expecting significant demand increases in certain commodities, there will naturally be a supply response, which means that, some projects will initially start higher cost, and then over time, as new supply comes into the market, they will become more cost competitive. So it's a bit of a dynamic process. There's a lot of talk about hedging and these types of things. I think hedging does have a place, although it is fraught with some danger if done incorrectly. Most of the time, most of the projects we finance do not have hedging. And that's because, generally speaking, not always, but generally speaking, financiers can take a view on price risk, provided that the fundamental economics of supply and demand apply. In instances when you have commodities that are highly specialized, where the supply chain is really controlled by one player, it is challenging because, the reality is that player can impact the market quite substantially. We can use words like prices are irrational, but yeah, maybe they are, but maybe they're not. They're just providing excess supply into the market. So it is very hard in that situation. So what financiers tend to do, and we've seen this being done in a lot of the projects, especially in the Northern Hemisphere, is we have been seeing them recommending or insisting in some instances upon forward or floor pricing in the offtake contracts to provide price support. In Australia, that is a challenging proposition because we are right next door to hyper-competitive Asian markets. And so the question is, which offtaker is prepared to actually effectively overpay in some respects to get, to get that relevant supply. So yeah, it is a challenging arrangement to sort of square, but the key is if you're dealing with experienced mining finance institutions like SocGen, Societe Generale, we're very experienced with solving for these types of issues.
Okay, thanks, Aaron. So market risk is obviously closely intertwined with geopolitical risk. And as political instability and regulatory changes in a region can significantly impact commodity prices, supply chains, and overall market conditions. Hey, can you tell us how geopolitical risks can be managed for those projects abroad?
Yes, Michael. I agree with you. Geopolitical risk is a serious issue and has a significant impact in the mining industry. And what we're seeing is a rise in nationalism and protectionism in certain countries because other countries are expanding their influence in a region. And one way to mitigate that kind of risk is to get political risk insurance, right? To get some of your investment back in the event of a political event arising. I've seen more failures with political risk insurance than successes because one, it's very expensive in the millions of dollars, and two, it's very difficult to actually recover under a political insurance, right? Sometimes it's political insurance have a lot of carve-outs, a lot of exceptions and limitations, and some of my clients have gotten into disputes, disagreements with the insurance provider rather than get their investment back. And another effective way to mitigate that kind of risk is, again, through the investment treaty I discussed earlier. So getting that protection, having that guarantee that the state will not just take away your permit because they want to give it away to some other foreign company, but that they will treat you fairly and equitably. And you might think, well, that's just another, empty promise by the state that you can't do anything about, that they'll just ignore. Well, there are real teeth in investment treaties, and the real teeth is the International Arbitration Clause, under which a mining company can bring an international case at the international level, so not at the domestic level, not at the local level, against that state. And it's a really effective way to do it because it works in two fronts. It works in terms of the process. You get a fair process because the International Tribunal decides the case, not local judges who might be biased against foreign companies. And the product that you get at the end as well, which is a final and binding decisions. And 90% of states, when they're told you need to pay this mining company X amount of money, they do pay. 95% of the states do pay. And those states that don't pay, because it's an enforceable decision, mining companies can force the states to pay. So I was involved in the Argentina cases, for example, several years ago, where there were so many decisions against Argentina from investor-state arbitrations. Argentina didn't want to pay. What the company did is they seized banking accounts of Argentina in New York City and were able to force Argentina to pay that way. And I see a lot of skepticism, and even in this room, I think about bringing an international arbitration against a state. That's not what investment protection is about, right? It's about having leverage and using it as a negotiation tool. It's about having that right to bring an arbitration and not actually bringing that arbitration. Because when you tell a state you can't do whatever you want, we are a protected investor, we're a protected company, they know what that means and they will listen. And they have a financial interest to listen because some states depend on World Bank loans, for example, to develop their economy. The World Bank has written policy that says, if you don't settle those kinds of disputes, we're not going to give you loans going forward. So it's a real financial interest and it's real teeth for states to listen to that. And you may have heard from Kingsgate yesterday. The CEO spoke about their international disagreement with Thailand on the gold mine. We represented Kingsgate in that disagreement. And we told Thailand when they wanted to expropriate it, take away that permit, we told Thailand, this is a protected investor. This is a protected company. There is a treaty between Australia and Thailand. You can't do whatever you want. Kingsgate is restarting production in the gold mine. So that's a really powerful and for mining companies, cheap way to get that control, to get that leverage in the negotiation tool.
Okay, no, thank you for that. So we've looked at, we've got the remnants of COVID. Obviously, we've got the Russian-Ukraine war, the issues in the Middle East. So our global supply chains are not as robust as they used to be. We're seeing increased costs, longer lead times. Companies are trying to find alternate sourcing solutions. Sanctions and trade barriers are a major concern at ramp-up stage. So, Aaron, can you tell us what lessons can be learned from past mining projects that experience significant cost overruns or ramp-up delays? And how can these lessons be applied to future projects?
So I think this is in many respects linked to the first point that I made around technical risk, and really the quality of the studies that's being undertaken to justify the project. I think one of the biggest lessons that I think really is about being realistic about the budget and about the schedule. I've been involved in several projects where it's the top leadership team is being very aspirational in terms of what the budget and the schedule should look like, and that's excellent from a team management perspective. And to try to drive incentives. This is, a fine approach. But it really doesn't work when it comes to setting a funding strategy. A funding strategy needs to be robust to take into account, the possibilities of things not happening according to plan. We all like to be optimistic, especially when you're so vested in a project after many, many years. And, management tends to really believe in the work they do. And it's great that they do, but you have to also have some introspection and think about some of the lessons of the past. And even on that topic, one of the things I do find is that management teams do like to talk about how their project is very different from the ones that happened in the past that didn't quite work out as planned. The irony of that discussion always is that the precedent transactions, the same management teams obviously looked at in the past themselves, but yet had problems. So I think a little bit of humility is really required, because the nature of mining is to address uncertainty. It's a different business than I'm in a global business. I head up the Australian mining team, and beside me I've got people in the infrastructure team and in the energy team, and I try to explain to them that mining is a different business in the sense of we have to address uncertainty in different ways. We're not just shipping equipment from one part of the world and then getting an annuity based upon a government contract. We're dealing with a lot more uncertainty. So one of the biggest lessons for me, I think, is about making sure there's enough liquidity in the bucket to begin with. This does come at a cost, but in my experience, it's less costly to raise the additional liquidity up front than to try to do it when you're in the middle of trying to build a project. Yep.
Right, thanks, Aaron. And we sort of touched a bit earlier on, investors are increasingly prioritising ESG criteria, and obviously, you're more likely to secure funding, influencing how the projects are structured and managed, providing that you've got the right processes in place. Stephen, can I sort of touch on your project? The federal and state government are discussing providing incentives on how Australia establishes a manufacturing industry off the back of critical minerals. Which of these policies are relevant to ASM, and does the government need to do more in this space?
Yeah, thanks, Michael. So ASM's actively engaged with both Australian and international governments in relation to our project. More specifically in terms of Australian support, we've got a letter of interest from Export Finance Australia. We found them to be fantastic to work with, as probably some other projects on this panel have as well. They've got great connectivity also with some of the international export credit agencies. So we've found that as we've worked with US Exim, the US Export Credit Agency, that EFA US Exim relationship's been very good. In fact, in the US, we've got a letter of interest of $1 billion Australian dollars from US Exim in terms of the project financing of our Dubbo project. The other group internationally that's been very helpful for us and other critical minerals projects has been Export Development Canada, based out of Ottawa. I guess I'd say they behave more like a bank in terms of their due diligence, but their appetite to support Canadian contractors and Canadian content in projects like ours is strong. So we've had a 400 million Australian dollar letter of support from EDC. Back in Australia, prior to construction, there are other programs that have been very helpful for us, particularly on the grant side. So we recently received a $5 million grant from the IPCM, or International Partnership for Critical Minerals program of the federal government, which we're immediately using on some of our further feasibility studies. In addition to this, there's been sort of more tax and royalty related relief from state and federal governments in Australia. So from a federal government perspective, we saw the 10% production tax credit, which will be very helpful for critical minerals projects once they get into production, as will the New South Wales royalty deferral program for projects in this state. Beyond that, people have probably heard in the press about the sort of Made in Australia program of the federal government. So there are other agencies we're in discussion with, such as the National Reconstruction Fund, who have about $15 billion at their disposal to invest in sort of midstream to downstream opportunities, which we qualify for. And then there are other government agencies who, I guess similar to Export Finance Australia, look to provide senior debt or mezzanine debt into projects like ours. So the Clean Energy Finance Corp is another group that we're engaged with. So yeah, I think we feel quite positive about the support from both the Australian government and the international governments for our sector. So much so that I think the I think the debt side of some of the large hard rock critical minerals projects is thankfully becoming slightly easier than the equity side. It doesn't mean that the equity side is resolved, but certainly the equity markets, when they look at that government support, it ticks the box and allows you to move to the next stage.
And how important are the ESG ratings to the viability of new mining projects? Can localising Western supply chains reduce dependency on global markets and support product provenance for end users? And what sort of trade-offs are you seeing in the market?
Yes, there's a couple of elements to that, and I know we're running short on time, so I think I'll just run to the specifics for our project. So one of the ESG ratings that is widely used by public market investors is the Morningstar Sustainalytics rating. So we put a lot of work into making sure that our project ranks well under those measures, and certainly relative to our peers, we are ranking very well under that measure. So much so that we've incorporated that measure into our management KPI. So annually, we've built ESG and ESG-related rankings into the management KPIs. Also, from a reporting perspective, as the CFO, this is something that's top of my mind, and also we've seen mentioned on other ESG-related panels at this conference is the need from a financial reporting perspective to start having your disclosures around scope 1, 2 and 3 emissions audited as part of your normal audit process in your financials. And so this is something that will gradually come in, but will be quite important. I was at a panel the other day where ASIC were talking about this from a regulatory perspective, that companies need to be ready and start thinking about their systems and talent internally for the ESG-related reporting, and you know, I guess reporting in a way that's not misleading and deceptive, because you can trip up under the ASIC regulations for that. Yeah. I think the second part to your question was around
I think we might just move on because we've only got a few minutes.
Okay.
And because I just want to just touch on, obviously there's a skill shortage, not only here in Australia but globally. Neil, from a mining sector perspective, can you share what the broader economic consequences of the skill shortage in the mining industry for both the local and the national economies look like?
I think there's been some quite significant impacts post-COVID. For Australia particularly, it was a boom time in mining. Effectively, the supply chain or supply and operations maintained through that period. Commodity prices saw great highs. That attracted a lot of talent to the industry, or a lot of demand, and I don't think that demand has really fallen off massively. That in itself is creating productivity issues. So you go to the government sector who are providing the permits and approvals to mining for new projects, their loss of talent is to the mining industry. So our demand, we're actually creating a problem for ourselves, and that is therefore creating a slowdown in terms of the new projects. If you're talking about 180 projects sat in WA in approvals right now, that is an economic hit that we're really feeling. In addition to anything around inflationary prices, when you go and get a coffee, or you go to a restaurant, or you go anywhere where you go and get your car serviced, those sorts of key trades and services can earn a lot more money within the mining sector, which is a plus for those individuals, but for the general economics of a state or a country, it's not healthy in terms of how it's driving inflation further. So I think we've got to lean in to see how we can resolve that issue.
Just quickly, as an industry, how can we attract new talent and bridge the space in growing that skill?
In the project development space, I think it's often you find people will come with previous experience of having developed similar projects, and the risk is they walk in and develop the same project that was developed 20 years ago. We need to be developing projects and mines that are looking like how are they going to look in 2040. So often you might find those individuals are not the right ones to be driving parts of that project. You need some open mind thinking from boards and executives to bring in experience outside of that commodity or even that industry. Talk data for ESG, data on how you're going to run. The future mine is not going to rely on people doing the jobs they are now, and your future generations are not going to be able to do the current types of work. They're not going to be attracted to it. They're not going to be capable of it. So you've got to imagine you are not going to bring in the next generation and walk them backwards in knowledge to old systems. You're either going to attract them into new systems and new ways of thinking, or you're not going to attract them. And the final thing is, I think as a country, we have to solve the social license issue, not at a local level, but at a national level around where mining is. Parents need to explain how they may be working in a big four, in a bank, but they're actually supporting the resources sector. 8 out of 10 people at the barbecue in WA will be working in a job that's associated with mining, maybe not for a mining company. But do those adults talk to their kids about what they're doing and what really that job is when they're in PwCs or the legal firms? You know, they're working in data, they're working in IT. It's not directly for a mining company, but I guarantee is more chance than not, it's going to be for the resources sector.
Yeah.
We can get that across to the future generations that works there. And I look at all the great stands out there with the technologies coming. So innovation is going to come quickly and quicker than I think we realize. Then that talent will come very quickly as the industry continues to innovate.
Okay, I think you've left us on a great note there, Neil. So we'll just draw to a close now. And again, just like to thank all our panelists. So Kate, Neil, Steve, and Aaron, thank you for all your insights. And I think it's been a very interesting conversation today. Thank you.